Hello, welcome back. A subscriber of the channel asked to compare two very well-known companies in the US, Walgreens and CVS. These are well-known pharmaceutical retailers. I've actually been to both when I was living in the US. Very popular ones. You can find them pretty much everywhere in the US. We're gonna be comparing them, see which one makes more sense to own, or maybe it could be both of those. So we're gonna examine the financials and kind of compare, trying to discover which one makes more sense, which one is cheaper, and a better company to potentially hold. Now this is the 1 month chart for Walgreens, but if you take a look at the 5-year chart, you will see that it has been going down actually, so there's a little bit of a downtrend. However, the max chart, going back from the back to the company's inception, looks like a company that is doing fairly well with again this recent slump in the last 5 years. So it has a downtrend. That's something worth noting, but it may be actually beneficial because it can give us a better price. Now, if we take a look at the financials, you will see a company that has a P/E ratio of 5.8 and a price to free cash flow ratio of 8.8. And that's a very good one, and this is where I'd like to get it, because we're talking about a company that is not really a growth company. It's a known retailer. You don't expect them to, they're not a tech company. So you do like to see this kind of P/E ratios and price to free cash flow ratio, and you kind of expect those. So that's a good thing to see. They also do buy back shares, 13% less outstanding shares in the last 5 years. That's a great thing to see. Now the free cash flow to total liabilities ratio points to a company that requires almost 14 years of free cash flow to pay back all its total liabilities. That's a little bit too much, but it's very kind of typical with these kind of retailers as well. And as long as there is enough free cash flow, that doesn't really concern me too much. It is a lot though, so bear that in mind. Now, the 5-year revenue growth has been positive, although slumping a little bit in the last year. But you will notice that this is the same thing pretty much happening with the company in 2020. Their net income growth, free cash flow growth really went down in these years. They got really hurt here, as you'll see. I guess the pandemic really had them put in a bad situation here. And so the debt to equity ratio, you would kind of expect this one to be elevated. Good return on equity though. And what's interesting here, what is very interesting, is the dividend yield. They are actually paying 4.4 almost percent. And they have a dividend payout ratio of 26, which is very sustainable. So I do expect them to be able to sustain this dividend for a long while. And that's a very good thing if you are looking to get some company to hold for a long time and actually make some income out of it. So if you are looking for a company that actually pays you, then this may be a good one. Now, I do want to jump to the stock evaluation tool and actually try some estimates here. So the revenue growth of the company is generally speaking rather low. We're gonna go with, let's go with 3, 4, and 5 for our 5-year. This may be a little bit too much. Actually, I'm gonna go a little bit lower. I think it's actually a little bit too much. Let's go 2, 3, and 4 over here. The net income margin is fairly low as well. It's 1, 2, and 3 again makes sense here. These kind of companies do operate on very low margins, of course, retailers. And these are actually sort of like discount retailers. They're very cheap. And the free cash flow margins are actually fairly good here. I'm gonna go with 90, 100, and 110. And the annual return is 13, is what I want to be getting, is about 13%. So I hit calculate. And you will see that for our low estimates, we're a little bit more than what I would like over here, much more actually. But for our medium ones, we're well within our range. And so for this kind of estimates, we are right on the money. So we could be buying some Walgreens here for this kind of projection. So yeah, this is a company with relatively normal projections. It would be a buy today, it looks like. Now let's switch it and take it back to CVS here. We're going to examine CVS. The stock tool is fetching market data and does some analysis on the back end. So it actually does take a little bit of time, a few seconds. And yeah, this is done. And so we go back to our stock analysis tool first, and we will examine the company's financials, the key metrics pretty much. Now you will see here that the company is trading at $99. The last 5 years has been going higher actually, so it's a different story than Walgreens. And what about the max? The max is also higher, but we're looking at a company that it's almost at its highest highs here. And so this is something to notice. It may be a little bit expensive. Now the key metrics, notice the PE ratio and the price to free cash flow ratio. The PE ratio is a little bit elevated when you compare it to Walgreens, but the price to free cash flow is the same. Remember, it was about 8.8 actually for Walgreens, so it was actually higher for Walgreens. This is better. Now, the thing about this company is actually issuing shares, so they are actually trying to take advantage of the stock price, which means that they probably believe the stock is overpriced, otherwise they would be buying it back, right? So, the free cash flow to total liabilities is less than Walgreens, though it's 10. And the good thing about CVS is that it looks like it's increasing its revenue growth and net income growth, free cash flow growth, and total equity, and by good margins here, as you'll see. Now, they do have some debt, of course. They have some good return on equity. It's okay, it's not great. But the dividend yield is 2% and the dividend payout ratio is 34%, 34.3%. A little bit more than Walgreens, but still well within our permitted range, which would be less than 50%. As you will see here, less than 50% is preferable. So the next thing that I want to do again is take it back to our stock evaluation tool. And let's do our calculations here. So the revenue growth, what we're going to be using, is going to be higher because the company is doing higher revenue growths for the most part. So it's going to be 5, 6, and 8 here. The net income margin, again, it's fairly the same, like 2 to 3%, I'd say, for the most part. Yes, so we're going to go 1, 2, and 3. And the free cash flow margin, apart from this year, which was the odd one out, I suppose, we're going to go 80, 90, and 100. And 13% again, same thing. We hit calculate. And you will see that for CVS, our current price is $99, almost $100. Yet our medium estimates are at $68 and our high ones are at $125. So for our high ones, we are within our range. But for our medium ones and low ones, we are far above those. They far exceed them. So what would I be doing? Which one would I buy? In terms of the financials of the company, I think I like CVS a little bit more. It looks like they are doing better, and I like the fact that they are increasing their key metrics, like the revenue, their net income growth, their free cash flow growth has been increasing instead of going down. I don't like the fact that they are actually issuing more shares, because that makes the stock overvalued. And their PE ratio is probably not something that I would even consider at all. Really, I don't pay too much attention. I mean, it's good to know it, but the price to free cash flow ratio is much more important to me. And this is actually better than Walgreens. So the thing is, I do like Walgreens because it's cheaper than CVS, all things concerned, of course. So what I would do here what I would look to do is if I wanted to buy one of the two and just one of the two and none at all, no other at all, like I had to pick one of those, I would probably go for Walgreens because it's cheaper. And I think it has a little bit more potential for increasing its stock price. But CVS is also doing very well in terms of its financials. It's a little bit more expensive. However, I like both in the sense of dividends here. So I don't think you can actually go bad with either of these two companies. So you may be paying more though to get Walgreens. That's the thing. So you may have to actually be okay with your higher estimates. So it's a little bit sort of like borderline if you want to buy it or not. So I would definitely consider buying both of these, maybe even maybe 70% Walgreens and 30% CVS, something of that sort. But if you are willing to buy both, I don't think you are going wrong with any of those really. But CVS, it would be nice to get a little bit of a better price. And of course, you can make your own estimates and have your own opinion about what you saw here. And at some point, when this platform is actually opened up, all of you can actually try your own estimates and see with your exact estimates what you want to be getting the company at. This will happen soon, in about a month or so. So you may want to stay around. So remember to subscribe, because I will let you know about it. And while at it, please like this video as well, because that really helps with YouTube algo. So, thank you for watching this one. I hope you enjoyed. And in the meantime, take a look at the video that I made earlier. It discusses Starbucks, a company that many of us like. I like it a lot. But is it a nice investment? That's the question. And take a look at this video to discover it. Thank you for watching this. See you in the next one. Bye-bye.